Welcome to the Money Tree Real Estate Investor Podcast, where we learn from real estate professionals across the industry. They will share about how they got into real estate, the big wins they have celebrated, the mistakes they have made along the way, and the advice they have for anyone following in their footsteps. Money really does grow on trees. Hey everybody, it's William Hollins here for another episode of the Money Tree Real Estate Investor Podcast. I've got a special guest today with a great story, Jon De Los Reyes. We're happy to have you today, man. And tell us a little bit about your background before you got into real estate.
Hey, thanks for having me, William. So I started my career in the Philippines. That's where I grew up. So back there, you're expected to be one of three things: an engineer, a lawyer, a doctor. I don't like the hospital. I don't like reading contracts, and I was good in math. So that was an easy pick for me. So I was an engineer. My first ever job was with a big automaker back home as an apprentice, and my salary was $5 per day.
Is that US dollars?
Yeah, $5 a day. I converted it, but it's equivalent to $5 a day, and $3 is my gas money already, right? So you can imagine that. So when I moved here in the early 2000s, and I got my first job, I had so much appreciation of money, even though I was paid at such a low hourly rate, right? I had so much appreciation for the money that I'm getting. Um, I worked my way up. I spent over a decade in oil and gas as an engineer, project manager, and production manager. I managed manufacturing facilities. And then I would go to manufacturing facilities with my uniform. I would get in machines because, we have machineries. Summer, winter, doesn't matter. And I got tired of the job. And I told myself, if I could only find a corporate job where I would dress nicely, talk to the CEOs, the VPs, that'd be great. So I transitioned there. I also took my MBA. I wanted to focus on investment management, trading stocks. I spent a good amount of time trading stocks, managing a portfolio for people. And I quickly realized a lot of things that I didn't like about the stocks, and we can get into that later on. From there, I realized that I won't be happy working for anyone that is not aligned with my values, my goals. So I decided to start our own business. Our first ever business was an Amazon business, an e-commerce business. That's what gives us the cash flow. And then but I always wanted to be in real estate. So that's what's going to give us capital gains. So if you connect the two, Amazon is the boxes piece, real estate is the buildings piece. So I plan to write a book next year called From Boxes to Buildings, which is, how I started from Amazon and how we transitioned to real estate. And now we invest in apartment buildings as well.
That's really cool, man. So yeah, you grew up in the Philippines. I know you've got some pretty unique hobbies as well.
Yeah.
You were in the racing scene for a while. So how did you get into that? What drew you to fast cars?
My uncle invited me to an open track day one time. We drove, I think it was Cadillac CTS-V, 500 horsepower, 500 foot torque. And this was back in, this was over a decade ago. And we drove on the track and I just loved it. You don't have to speed on, you don't have to, have the urge to speed on public highways. You can let it all out on the track. And surprisingly, you actually feel much safer driving on the racetrack than the public highways. I kid you not, because some race car drivers, or most race car drivers, are more disciplined. So yeah, I was in the racing scene for quite a bit until I had to sell my car during COVID just to save one of our businesses. So hiking in Iceland was probably my favorite trip. So we were there for 12 days. And day one, we saw the Northern Lights, right? And then we would hike to the northwesternmost tip of Iceland, very remote, no one lives there. And we spent the entire day just doing an 8 mile loop. And this 8 mile loop is it's pretty hard. You have to go up and rappel down. Yeah,
Wow.
yeah,
So you tied yourself off and everything and to do that?
yeah. You had to. So one of our best
That's awesome.
vacations ever. So
Yeah, I've never been to Iceland, but I'd like to go at some point. I did a hike in Taiwan a few years back, and that was probably the most exotic hike that I've done so far. And the end was probably a 250-foot waterfall or something like that.
oh, wow, see,
So
you get the
beautiful.
part at the end. Yeah, it's awesome.
Absolutely, man. So, okay, so let's kind of dive into real estate a little bit more. Obviously, you had a master plan of building some cash flow first, and then, hoping to build long-term equity and take care of building some generational wealth. So, tell me about why you got into real estate initially, and what was your journey to get there?
Yeah. So I took my MBA because I wanted to shift to investment management, right? Run a stock portfolio. Um, so we would value a stock and come up with a stock price. And then we would tell our investors, hey, this is a buy, sell, or hold, and we would trade on their behalf. Every time a stock would move plus or minus 5%, we would have to create a report, send a report out to the investors after doing an extensive research saying this is what happened. Um, there were several times when I sent reports to investors saying it was nothing happened with the company. It was basically a tweet from the president or the Fed chair or something like that. So that's when I realized that stocks by external factors that shouldn't influence it, right? Social media, it's becoming an emotional game. I didn't like that fact. And also, 90% of funds underperform over a long period of time. So that's something that I could not pitch to my investors, right? So I looked for other sources of income, and right after I graduated from my MBA, I took the Amazon course and then launched our first business there. The idea was to start with Amazon to build cash flow because you may have good net worth tied to assets, but how are you going to be able to pay for your expenses on a monthly basis, right? So you need cash flow to come in. So we started an Amazon business. Once that's providing good cash flow, then we can jump to real estate. So that's always the end goal, to be in real estate.
Absolutely, man. So now that you are in real estate, what type of assets are you focused on? Are you passively invested in deals? Are you raising capital? Kind of where's your expertise lie? And then let's go from there.
We focus on multifamily assets here in Houston. I think we're a little too focused now in Houston. We need to diversify, but Houston and Dallas are such great markets, and it's our backyard. We can drive by the property. So we focus on 100 plus unit multifamily assets, Class A. Class A meaning those are the more luxury, stabilized properties, newer builds anywhere in 2000s and up, maybe 2010 even. And then Class B. Class B is a little bit lower on the median income level. There's a lot of opportunities to renovate the units and then bring the rent income up, right? So Class A's and Class B's, 100 plus unit apartments are what we're focusing on. We invest both passively, right? So we send our capital to the team that's going to manage the asset, and then they provide us, anywhere between 80 to 120% return in 3 to 5 year time frame. But we also invest actively where we're actually the ones managing the asset, right? Between passive, we have about 800 units, apartment units in Houston. On the active side, we have about 624 units that we're managing.
Absolutely, yeah. So, just to give a little bit more technical terminology here for the listeners.
Yeah.
So, a lot of the people that we have on are syndicators. Multifamily specifically is obviously a popular asset for a lot of different reasons, and I really like multifamily. That's what I'm focused on as well. But most people are buying B and C class multifamily apartment complexes, so those are value add plays. They're going to go in and renovate it. When you are buying A class apartment complexes, a lot of times those would be more of like a core property or a core plus property. And so, would you be able to describe a little bit more about that, what that means, and how that business plan strategy is different than a more of a value add play?
For the class A, you
Mhm.
mean? Okay. So here's the key. So our strategy is we invest in a class A asset in a class A area, right? So that's the first, or ideally, class B asset in a class A area. So you have to look at the area and the asset altogether, because the first scenario, class A asset in a class A area, you know that there's median income or a high median income in that area. So you're safeguarded from, say, we go to a recession, right? This community has money to make sure that they can still pay for rent, right? So that's one. If you have a class A asset in a B area, when the market gets tough, people will move out of the class A assets into class B assets because it's a little cheaper. So that's the idea behind it. On the flip side, the other way you want to see it is a class B asset, right, in a very luxurious area, right? Because you know there's median income that's going to be supporting the rent payments or rent increases. So on our class A, it has the lowest delinquency, the highest renewal rate, and then they can easily raise rents much easier than class B's. So right now, I just got a report from our class A asset that year over year they increased 7%. Um, income, and that's been consistent for the since we took over in September. Every month they send a monthly newsletter, because if you invest passively, you receive monthly newsletters from the sponsorship team saying, "Hey, this year we increased 7% for all the renewals," and then you just keep on seeing that trend. We keep on increasing by 7% for all renewals. So it's a safer bet. Honestly, a class A has the lowest return, but it's the most stable property. So you're somewhat de-risking yourself, right? So that's the beauty of a class A. The beauty of a class B asset is you have this upside to capture, because if you renovate these units, say you go from a Formica countertop to a granite countertop, that's potentially, and then, obviously the other kitchen fixtures, you can increase the rent by another 150. If you go the higher level, you go say quartz and then stainless steel appliances, nicer LED fixtures, that's another 150 that you can add on rent income. So all that rent income goes to running the asset, and eventually returns to passive investors.
Absolutely, yeah. So thank you for making that distinction. So, the A properties and A locations, as you mentioned, that's kind of a core strategy. And a lot of those properties are going to be a lot more units. They're going to be a lot bigger. And you're going to be, purchasers, people that are going to be trying to buy those properties. That's going to be a different class of groups trying to buy those properties as well. So a lot of private equity groups, a lot of institutional capital is going to be pursuing a core strategy investment. So the things that they think about and the things that they appreciate are, maybe some stronger cash flows,
Correct.
but not as high of an upside upon sale. And so it's a safer bet. You know that that area is going to most likely stay really strong for a long time, and there's obviously, like, young professionals maybe making more money in those areas, so it's a safer bet. So, like you said, it might be a great idea for people that are looking at investing in multifamily value add properties to also, hey, let's think about getting into a core property or a core plus property.
Right.
That way we are measuring our risk and thinking about those types of things. So I definitely appreciate you being able to talk about that and describe that, because we haven't had a lot of people purchasing those types of properties on here.
Yeah, and actually we have a range of different classes from B minus, maybe borderline C actually, to A, right? So we talked about the A, the good Bs, and then the B minus ones actually take more re-tenanting. That this is where you have an asset in a location where the median income is, kind of lower meaning 50K or lower, right? But surprisingly, one of our B minus assets or borderline C is actually the best performing asset that we have. We keep on talking about the property and the market, but the most important aspect of a deal is the team, the GP team that's managing the asset. We vet these operators very well. That's why we went with them, even though the property is in a pretty rough part of Houston. And we did a lot of research, and sure enough, we made the right decision to invest in this B minus asset. And this is our best asset in our portfolio, actually.
Passive investors in real estate are able to receive a check every month. Some people call that mailbox money. We say money really does grow on trees. Visit the website at biggerpictureholdings.com, where we have a ton of free resources to help you learn more about planting your very own money tree. Speaking of Houston, I know we talked a little bit beforehand. So obviously, you've invested passively in some deals. I'm investing passively, getting a little bit of return on a monthly basis or quarterly basis, depending on how the deal was structured. There's obviously a lot of positives about investing in real estate, but we talked a little bit beforehand, and obviously there's some horror stories from investing in real estate as well, and I think it's important, and I think it would be a disservice to listeners to not talk about those stories as well. I don't want to just paint a really bright picture, and I just want people to know. So could you share a little bit more about something that you've heard about that happened recently and is affecting some properties in Houston?
I'm so glad you brought that up because you hear a lot of pitches and it's all rainbows and butterflies, and it's not that. It's a business. There's a lot of things that can happen, and I want to share two stories. The first one was probably the second deal that we ever looked at, multifamily wise. So you get a memo or an offering memorandum with Photoshop pictures, right? Beautiful pools, really nice sky, blue skies, and all that. But I encourage you to, if you can, if you're in the area, drive by the property. Don't go down, but just drive by the property, do a property drive by, and see if this is something that you would like to invest in, or is there a lot of crime in the area? So when we went to this property, it's a portfolio property of I think 600 or 800 units. I can't remember now, but when we drove by the property, they only budgeted 1.4 million to do the capex renovation of the units.
How
Um,
many units was it?
this is I think 600 at least. So that's nothing. 1.4 million over 600 units is nothing. You're not going to be renovating a lot, right?
That's 2,300, roughly $2,300 a unit.
No way.
So,
I-
that's not even enough for buying all the materials that would be needed,
What's
let
that?
alone the labor.
Yeah, it's four dishwashers, right? Like per unit, right? Oh, four dishwashers, like $2,000, right? So it didn't make sense. When we went by the property, the windows are covered by pizza boxes, right? There are people hanging out by AC units, having a party, having a pizza, and drinking, and it didn't make us feel comfortable, right? Um, so we don't want other investors to fall into this trap of just, especially the ones that are not in your city, not living in the city, right? Out of state. Don't fall into the trap of just taking it by the numbers. You got to do your own diligence. Because of that experience, we actually developed a checklist that we've been sharing to a lot of people, that goes through these are the questions that you have to ask the team that's managing the asset, at questions about the property, questions about the financing, questions about the submarket, right? So that's been super helpful. And this checklist or saved us a ton of money from investing in bad deals. So because we don't want that for our investors, and unfortunately that happens. And this property is now being taken over. This is a year and a half late, 2 years later, being taken over by the city of Houston because the current asset managers or operators are not doing a very good job, right? So that's the first story. The second story is starting with the GP, the right GP team. I didn't invest in this property, but we had him as a guest on our webinar. And he said that they bought this asset in Arizona. They have a very, very strong team. They had a fire in one of the buildings. I think a tenant, I don't know if it's a tenant or a friend of a tenant, um, burned one of the building units, affected 10% of the units. They had
Wow.
massive plumbing issues that they spent $400,000 on plumbing issues that were not disclosed by the seller. But because they were there physically every single week, even though they live out of state, every single week they make an effort to go there. They were able to make a 3.6 times return to their investors, despite the issue that they had. So it all starts with the operator that's going to be managing the asset. So imagine if you put in 100K, after 3 years, they held it for 3 years, they got $360,000 total, including the capital that they invested. So that's a 3.6x returns. Despite the problems that they had, they still provide stellar returns to their investors because they have a very, very good GP team.
It's really awesome, man. Yeah, I like how you kind of tempered, the negative with the positive because there are a lot of good stories and there's a lot of bad stories. And I
Yeah.
think, just just want to be careful. This is investment. Like we work hard for our money,
Oh gosh, yeah.
and you want to be wise about who you invest with because you're
That's
investing
it.
in people.
That's it. You're right. You are investing in the person first, the GP team, and then the deal. I asked that person, the second GP who did very well. So, what is your worst and best investment or property? And he said, "This is it. I had the worst experience at this property because of all the issues, but this is also the best because we were able to provide really good returns to our investors."
It's awesome. Love it. Well, hey, so before we finish up, I always want to give you a chance as the guest to be able to just brag on yourself for a moment, talk about some of your proudest accomplishments in real estate so far. So here's the mic.
Awesome. Well, the achievements wise, we're very happy with how far we've gone. We have so much more to cover, but if you look at the gap, right, what we need to cover versus the gain, what we've gained over the past 2 years of investing in apartments, we were able to invest in 5 properties. Two of those, we are general partners, and we got into our first GP deal within 6 months, right? So we're very proud of that. But you know what I'm more proud of are the relationships that we've built because I can't think of any year where we've grown so much than 2021 and 2022 because as cliche as it may sound, you become the average of the people that you hang out with. When we first started in this business, we were rubbing elbows with multimillionaires and we felt uncomfortable. But now it became the norm and we're striving towards that as well, right? And we've increased our net worth significantly over the past 2 years. So very happy about that. We're focusing on multifamily. We're starting a new fund, working with partners of ours. In this fund, the first fund is going to be a $10 million fund focused on Houston assets, working with just the top operators that are aligned with our values. And our values are transparency, someone with good track record, someone with $100 million AUM, because we want to de-risk our investors from investing in these bad deals. So that's the model of the fund. We're building that fund, focusing on Houston assets. Again, it's a $10 million fund, and we're going to be investing in apartment buildings.
Absolutely. So with that being said, that fund, what's the buy box on the fund? Because I know you have to be very strict. You have to clarify, exactly what you're going to be doing. You cannot stray from that when you are building a fund because that's, super regulated, obviously.
Yeah. So when you say buy box, what do you mean?
So the type of properties and the
Oh yeah,
class of properties. I know that the market is Houston, but what are you going to be focusing on in the fund?
yeah. Fund terms will be Class A and B properties over 100 units. The IRR is 15% or up. That's the IRR threshold. The operators that we're going to be working with have over 100 million in assets under management. And so those are the four strict ones. The kind of soft ones are we prefer also a company that's vertically integrated, meaning they have their own property manager. Because if they do, then that cuts down the cost, right? And the last piece of it is, have you heard of PFCs?
PFCs, I have not heard of that.
This is something new. I think it's Public Facility Corporation. So this is a tax abatement play, right? So we toured a couple of properties. I can't name them, but the idea here is if an apartment building, if whether it's Class A, Class B, Class C, if you keep the rents of half the units at 80% of what the area median income can afford, you're not going to be paying property taxes. And that's huge. That is huge. So look at PFCs online. These are tax abatement plays for apartment investors. So if there's something like that, that's also good because if you just keep or stabilize the property, keep it as is, not a lot of renovations, then you don't have that risk of I renovate this, am I going to get the premium, right, that I want? But this is the most of the returns for PFCs are going to come from savings from property taxes.
That's pretty cool. Yeah, I haven't heard of that. Is the PFC, is that something that's a regional code? Is it Houston based or
No,
is it a national thing or
I know Texas has it. I'm not sure
okay.
about other states, but I know Texas has it.
Hmm, that's
And
cool,
that
yeah.
if you look at it, it's somewhat of a safer play right now because not a lot of, let's face it, not a lot of deals are working out right now, not or not penciling in, meaning the asking price is still high, but the sellers are only willing to sell, or sorry, the asking price is this high, but
Hmm,
buyers are all only offering this price. So not a
right.
lot of things are working out. But this is a very unique and creative play right now that is also new to me. So
Absolutely, yeah. And I've definitely had investors that have brought up that kind of impact investing concept. And it's like, well, hey, like I don't want you guys to push out all of the residents, and I mean that's not what we're trying to do anyway, right? But that is a casualty of this type of investment sometimes of, especially if somebody's is delinquent and not haven't been paying their bills. We
yeah,
we certainly, I mean, we're trying to operate a business and certainly want to have them move on to somewhere else.
yeah.
Um,
And that's what you get with Class C properties as well, right? So, and a lot of and if I can share one more thing, if you're an investor, if you drive by the property, look at it from a lens of an investor, right? Am I going to invest here or not as a tenant? Am I going to live here, right? So you have to have the investor lens, not the tenant lens when you go here, because if you drive by these B minuses properties, they're good if you look at the financials, but would you live there? Maybe not, right? So you got to change that lens. But we have a lot of exciting things going on this year. The fund is one. Another asset that we're jumping into is residential assisted living. All right. The goal is to open 3 facilities here in Houston. Um, we are in the forefront of an aging population, and we want to be able to provide quality care, senior care living to our aging population. So I think there's a huge need for that, and we want to serve that population as well.
Absolutely, man. Well, John, I've enjoyed having you, and I certainly want to hear more about your fund. So when all that paperwork gets done, man, I'd love to have you send that over my way.
Sounds good, man. Be happy to help.
Awesome, man. Well, how can people get in touch with you?
Yeah, you can. So I mentioned the checklist. It's on our website. If you go to dlrx.us, again, DLR is our last name, De Los Reyes. It's also short for dollar. and X is multiply. So we multiply an investor's dollar by investing in real estate. So dlrx.us, there's a big button on top where you can download the checklist and take that with you when you do your property tours. It's a very detailed list, so you know what you're looking at and you know what to ask the team.
Absolutely, man. Well, thank you so much.
Thank you. Thanks, William.
Like and subscribe below. A new episode will air every Tuesday at 7 a.m. Are you looking for more content? Visit our website, biggerpictureholdings.com. And remember, money really does grow on trees.